Mainly, though, I think Revolve sold off because the investor base was expecting too much. That's why I told you not to buy this thing when it was trading in the 30s. Bad holders. Your enemy, fellow shareholders. So when Revolve didn't totally shoot the lights out and then gave you spectacularly optimistic forecasts, these weak-handed shareholders dumped the stock. They had to give a big guide up and they had to have a big beat, and they didn't give it. In my view, management's being reasonable. They're responsibly using their cash to build out their lower-end site, Super Down, along with a bunch of private label brands. These guys don't want to overpromise. That's a good thing. And there was plenty to like about this quarter if you cared enough to do the homework. Revolve's revenues accelerated. Their gross margins increased. Imagine any of these other retailers having that happen. Their total orders grew by more than 30%. The platform's still in great shape. That's why so many analysts have reiterated their buy ratings. Some of them even raised their price targets. But in this brutal market, none of that seems to matter, which is why you're being given the chance to buy Revolve at such a huge discount. We wanted a pullback. Now we've got one. At these levels, Revolve is selling for about 29 times next year's earnings estimates, roughly 21 times the earnings estimates for 2021. 20 times earnings for a company with 20% growth? Okay, that's not bad. We've seen a similar weakness in the stock called Real. I don't like that name. It sounds stupid, but you know what? WeWork sounds good, and I think that's a bad investment. Real is the online consignment shop where they'll help you sell your used luxury accessories and apparel. Now, this stock plummeted 23% on Friday. No apparent reason I can find. Then last night, the company reported a seemingly great quarter. Fabulous numbers across the board. What happens? After opening up 10%, I thought that was interesting and perhaps correct. Real got dragged down by the market, giving up all of its gains, ultimately closing down 16%. I'm sorry, that kind of reaction borders on the panic. I don't think that represents rational thinking. Again, I think you can start building a position right here and then buy more if it keeps failing, so leave some room. I mean, we have to understand, these stocks they could be falling knives. Where's my falling knife? Here, we'll use this one. It could be like, no, I like that one. I don't want to do that. What happened to my Bowie knife? Okay, this is a depiction of every single stock that people are thinking, including these, okay? And I have to tell you, you can't catch this. Watch, you can't catch it. See, that would hurt, right? So what you do is you catch a little of it. It makes it so it's not a knife if you catch a little of it. Here's the bottom line. This is a horrifying tape. But stocks really do get cheaper as they go lower. We can't throw out some of these guidance, some dictates that we live by, the dictums. We told you to wait. We waited. And now we're greenlighting Revolve Group and the Real because their stocks have come down dramatically, even though the actual companies are in very good shape. The long-awaited buying opportunities arrived. Don't be afraid to take advantage of it. Just remember, the market's so horrendous that you need to start small and stage your buys gradually on the way down because there's no telling whether these two beaten-down stocks will bottom anytime soon.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.